Timeless Wisdom, Warren Buffett's annual letters to Berkshire Hathaway shareholders. Each year, Warren Buffett writes an open letter to Berkshire Hathaway shareholders. Over the last 40 years, these letters have become an annual required read across the investing world, providing insight into how Buffett and his team think about everything from investment strategy to stock ownership to company culture, and more. At the age of 26, a Nebraska stockbroker and school teacher named Warren Buffett took his retirement fund of $174,000 and decided to start his own investment business. 2 decades later, he was a billionaire. Today, the Oracle of Omaha has a net worth of around $85 billion, making him the 4th wealthiest person in the United States after Jeff Bezos, another CEO known for his shareholder letters, Bill Gates, and Mark Zuckerberg. Berkshire Hathaway, Buffett's firm, has the most expensive share price of any company in history, with each Class A share costing upwards of $330,000. Berkshire Hathaway's fundamental strategy has been to identify valuable companies and then acquire increasingly large portions of them. Among its most valuable holdings are its stakes in juggernauts of the American economy like Coca-Cola, 9.3% stake, and Apple, 5.4%. Its most valuable stake, with a market value of more than $120 billion US. Berkshire Hathaway also owns just under 19% of American Express, 11.9% of Bank of America, and 9.8% of US Bancorp. It has purchased controlling stakes in some 60 companies, including well-known brands like Geico, Dairy Queen, and Fruit of the Loom. Berkshire Hathaway's portfolio is also full of more obscure successes too, like See's Candy, which Buffett calls his dream business. Buffett bought See's Candy for $25 million US in 1972, and by 2019, it had brought in well over $2 billion US, a nearly 8,000 times return. Investors in Berkshire Hathaway have also done well. Since 1965, the price of Berkshire's Class A stock has increased by more than 2,800,000%. That's compared to a roughly 23,000% increase in the overall gain of the S&P 500 over the same period. It's no wonder Buffett publishes an updated table of Berkshire's per-share performance alongside the stock index at the beginning of each year's shareholder letter, which has become an annual event in the world of business and finance. Beyond some tremendous wins, Buffett himself is in some ways another quiet success. He preaches the importance of fiscal responsibility, and he still lives in the house he bought in Omaha for $31,500 in 1958. He eats at McDonald's and drinks at least 5 12-ounce servings of Coca-Cola every day. This down-to-earth quality comes through in Buffett's letters too. In between accounts of Berkshire's current holdings, he tells jokes, shares anecdotes, and relates quippy aphorisms to help illuminate his core points. He mocks himself for making mistakes and sings the praises of Berkshire's army of CEO managers. He offers an investment philosophy grounded not in complicated financial analysis, but often in common sense evaluations of what a particular company is worth. The result is an eminently quotable collection of homespun investing wisdom. Price is what you pay, value is what you get. 2008. For investors as a whole, returns decrease as motion increases. 2005. Be fearful when others are greedy and greedy, only when others are fearful. 2004. You only find out who is swimming naked when the tide goes out. 2001. Below, we unpack 28 of the most important lessons from the last 4 decades of Berkshire Hathaway's shareholder letters. Together, they form a compendium of the beliefs and advice of the man widely regarded to be the greatest investor in history. Table of contents. Executive compensation. Executives should only eat what they kill. Don't give your executives stock options as compensation. Stock ownership. Buy stock as an owner, not a speculator. Don't ignore the value of intangible assets. Conglomerates earned their terrible reputation. Market volatility. Ignore short-term movements in stock prices. Be fearful when others are greedy, and greedy when others are fearful. Save your money in peacetime so you can buy more during war. Investment strategy. Look for companies that reinvest their earnings into growth. Don't invest in businesses that are too complex to fully understand. Invest in unsexy companies that build products people need. Stock buybacks are often the best use of corporate cash. Asset-heavy companies can be good investments. Value investing. Never invest because you think a company is a bargain. Don't invest only because you expect a company to grow. Never use your own stock to make acquisitions. Global economics. America is not in decline. It's becoming more and more efficient. Current board of director incentives are broken and backwards. Management. Embrace the virtue of sloth. Time is the friend of the wonderful business, the enemy of the mediocre. The traditional model of executive incentives is outdated. Adopting a culture of strategic patience can propel businesses from mediocrity to enduring greatness. In a world fixated on instant gratification, strategic patience emerges as the disruptive force driving sustainable success in modern corporate America. This video would be complete without talking about Charlie Munger, Warren Buffett's business partner. Lawyer by profession, he's witty and concise, and few years older than Warren Buffett. Charlie Munger, despite his background in law, has proven to be an indispensable asset to Berkshire Hathaway, contributing significantly to its phenomenal success. Here are some of his top 5 quotes of investing and life wisdom. The big money is not in the buying or selling, but in the waiting. Spend each day trying to be a little wise than you were when you wake up. A lot of people with high IQs are terrible investors because they've got terrible temperaments. Investment isn't a test of intelligence, it's a measure of temperament. High IQs can falter, while composed minds tend to prosper in the long run. Simplicity has a way of improving performance by enabling us to better understand what we are doing. If you found this video valuable, would you kindly like, share, comment, and subscribe? It helps us and the algorithm know that you value and appreciate this content. Thank you. Until next time.